The human currency, valuing relationships where behavior meets economics.
I'm going to make this clear from the outset. I have no gripes with the individual, with the person who invests their money in houses or bonds or gold or Bitcoin or Ethereum or shitcoins or Pokemon cards. No problems with the individual's right to use their stored time and energy, their money, in an effort to grow or hold stable that money over time. I've got absolutely no gripes with the property investor who's owned 20 properties, 100 properties. The problem that I have is with the premise of tax. So you work a job where you earn a wage and then you pay tax upon those earnings. You can't leave that money and that earnings in the bank. So you have to take risks with it. If I make money, if you make money, we have to pay tax. If I invest that money and I make a gain on that risk, I have to pay tax on the gain. So I've earned money, paid tax on it. Then I put that money at work and to risk. If I'm putting that into the stock market or investing in a private business or a venture capital business, I'm investing in the growth and innovation of other things and other people. It's already provided a productive good to the world. And then if I want to take my earnings back because the 1 in 10 shot that I had at choosing a positive investment that made me money, I owe more money to the government and to the system for which I've already put at risk. But if I lose money and I invest that money and I lose money, oh, that's fine. Now, yeah, cool. I get a capital loss that I can write off against a future capital gain. But the whole premise that I earn money and then I can't just leave it in the bank because it's losing value over time. Assets are going up over time. They go up every single year, on average 10%, 7%, 10% for houses, 10% for stocks, 14% for the S&P, which is stocks in America. And for the longest time, people haven't had to think in Australia. They've just plowed all their money into leveraging themselves as much as they can, working hard and buying houses and thinking, well, houses just go up just because they go up, because that's what happened for 50 years and it worked. But all these mechanisms actually affect the price of housing. Interest rates coming down over time, the leverage that a bank will offer and choose to lend, and money in the system having to grow to pay off the debt because it's a debt Ponzi scheme. So without getting too conspiratorial and sounding like a nut, I'm going to break down what these budget changes and implications are and what impact that will have on the average worker who wants to invest their money and get ahead, or wants to save their money over time, or wants to buy a house, and what these changes will mean. Capital gains tax is that tax that you pay when you make money on an asset. Now, that's not your house. If your house goes up and it's your only house and you live there, you don't have to pay tax on that. That's an exemption. But you have to pay tax on an investment that you make, whether it's in the stock market, whether it's on Bitcoin, a meme coin. And in 1999, Howard and Costello introduced a 50% capital gains tax discount, meaning that essentially, if you are at the tax bracket, the top tax bracket, because that's the easiest one to say because it's closest to 50%, it's about 47% with the Medicare levy. You get a 50% discount. So you buy a house for $100,000, you keep it for 20 years, it's worth $1 million. You go to sell it and you will pay, instead of paying tax on that entire $900,000 gain and getting taxed at your marginal tax rate of 47%, you'll only get taxed at half of that. You get a 50% discount of 23.5%. So it's a significant saving because you're, instead of paying $450,000 tax on that $900,000 gain, you only pay a $230,000 tax. Significant, right? It's a quarter of the growth in the investment that you made, the risk that you took. But what's happened in the last 50 years and 30 years in particular, accidentally these rules and negative gearing created a generation of Australians who confused a government subsidy with an investment strategy. They just bought houses, they held them, and they waited. And then the tax system rewarded them. And that's not a strategy. That's relying upon it. It's a habit. It's laziness of investment to just think, oh, I'll just do this because everybody else does this. You've got no thesis apart from the fact that you expect houses to go up over time. But why? Because there's so many inputs into that idea, and we're going to break them down, what those inputs are and what the changes will mean for those inputs. But when they remove the favourable tax clauses like negative gearing, like capital gains discount, that is significant changes to people who for 50 years have invested in property based on the rules that were put in front of them. They didn't create the rules. The government created the rules. People went, well, here's how I can benefit from those rules. Some people were very smart, intelligent. They understood leverage and they understood supply and demand, and the inflation of the money supply would mean that the scarce desirable assets like houses and good houses would continue to go up over time while the money supply continues to inflate. There's no choice. It has to. And that's the exact same reason why you can't leave the money in the bank, because you're getting diluted every single year by 7% dilution every year, meaning that your money is worth 7% less every year unless you put it to work. So while young people are saving for a house now, maybe they can save $20,000 in a year as a couple or an individual. Every year it's going back 7%, which means you save that 20 grand. The next year you continue to work and save. You've lost $1,400 in your purchase ability. Residential property investment in Australia, the yields are so low, right? So the yield is the return that you get on an investment. So let's say you put $100 into an investment and it gives you $10 back as a dividend. It pays you $10 each year. Well, that's a 10% yield. And at the end of that 10 years, you're going to get 10 times 10. You get your entire $100 back, but you still keep the asset. So you've got a yield of 10% and you keep that $100. But remember, the money has inflated. It's lost value. So that $100 is no longer worth $100 anymore. It's more worth like $50 over that 10-year span. But you got $100 in your pocket from the dividends, from the yield. Now, it's an abstract concept, but property is yielding between 1 to 3%, which is an extremely low yield. That means you might buy an investment property for $1 million, and the rent on that might be $20,000 to $30,000. That's 2 to 3%. But you have all these costs associated with it, like the upkeep of the property, the interest that you have to pay on that debt. So they lose money. You end up losing $20,000 to hold an asset, but that's allowing someone to rent. So if you remove the ability to write off that loss of the interest repayments and the decay in the house to keep it up and the rates, the land tax, you have to get your electricity and gas certified every 1 to 2 years, and all the damage that's done to the property in the meantime by the renter, it's meant that they might get $20,000 rent, a 2% yield, but the interest and all those costs added up mean they actually lost money. You take off it cost them $30,000, $40,000 in total. So they lost $20,000. All negative gearing means is that $20,000 loss that they made for holding that asset comes off their wage. So if you're making $100,000 and you're invested in that property, according to the government, you now only earned $80,000. That $20,000 loss comes off your income. You still pay tax. You don't save $20,000. It's not $20,000 in your pocket. It's more like 7 to 8 in that instance in your pocket. A saving of $7,000 to $8,000. Now, because the investor who bought that investment property can negatively gear a property and write off the losses, it means that they can afford to charge a lower rent. So removing negative gearing will mean that rents will go up because they now need the yield. They can only make an investment if it has good yield, 4, 5, 6% yield. The only reason the property investor buys that property is for one reason, and it is punting on growth of that asset, punting on growth of the property. If all these changes reduce the growth, long-term, short-term, medium-term of property, people will no longer invest in property, which the supply-demand mechanism, where we have an undersupply of houses and an oversupply of demand, means houses get bid up and they continue to cost more. If a whole bunch of investors decide that these changes to the tax law destroy that investment vehicle, then they will sell their properties sooner rather than later. And that will mean the supply increases and the demand stays the same. The demand hasn't changed. Well, the demand's got lower there because if investors are selling, then investors aren't buying. And some investors might buy, but if someone's owning 15, 10, 5 houses, or even 2 or 3, and they're selling that supply on the market, the demand's probably going down, the supply's coming up. You as a first home buyer, you just got a leg up because there's less demand in these investable properties, which are generally going to be first home buyer properties. Now that's good for the first home buyer. It's bad for the renter because rents will go up. Or maybe the price comes down of these properties, which means the yield goes up. That's the same thing because it will cost someone only $750,000 and for that $1 million property. And if rents stay the same, then they're going to get 3 to 4% on that $750,000. It will maybe encourage some investors that will see that yield. Negative gearing survived for new houses only. So that's another mechanism where the government is incentivizing investors to still invest in property. You'll still get negative gearing. You can still write that loss off, but it has to be for a newly built property, which thereby, by definition, is more supply in the market. So you might have investors with old properties selling. Now, it's grandfathered, which means the negative gearing, if you currently own a negatively geared house, that's fine. You'd probably just hold it because you continue to make that situation real. But the impact will be longer term. It will bring house price growth down, which is not necessarily a negative thing. These changes are not a negative thing. They probably should have happened 20 years ago, but they didn't. And so it's caused Australian property to have this, it's at the top of the treetop in terms of its leverage and its growth, and how expensive it is and how inaffordable it is for anyone, for renters and for people who own houses and for the investor. It's confirmed what I've been saying for the last 2 years, which is property as an investment vehicle is a horrible investment. The growth is gone. We have 125% public debt to GDP, which basically means GDP is the growth of the country. When you get to 130% debt to GDP, and this is usually in a private sense, this is America at the moment, they have a lot of government debt, that results every single time in a debt spiral where the interest outweighs the growth that they can make and the currency inflates away to zero and poof, it's gone. Look up any historical context of Argentina, Zimbabwe, Weimar Republic, Germany, and the mark. There's hundreds of currencies that have gone to zero and inflated away. But when the debt is so high, it means there's no growth left. The banks aren't regulatorily allowed to loan more money. They can't create another credit cycle because they already have so much debt attached to their balance sheet. Now, it's owned by the public. The public, you and me and the neighbor, buy the house. We don't buy it in money, we buy it in debt. You buy $1 million house with a $100,000 deposit. You pay your $70,000 stamp duty, which is just another government tax. And then you borrow $930,000 or $900,000 and you pay that off over 30 years. And it ends up costing you $1.7 to $2 million to pay off that debt. That's the way historically that it's worked. But because property has continued to go up and you buy that property for 1 million, but in everyone's mind, property always goes up. So in 30 years' time, when you do pay it off, it's actually worth $3 million or $2 million. Well, if it's worth $2 million, it costs you $2 million. So you haven't made any money there, but you've stored your value relatively stably. The property investor and the person who buys a property because they want to create wealth and they think they're creating wealth, it needs greater growth than that. It needs to be, you buy it for 1 million, it needs to be worth 4 million in 30 years. Otherwise, it's not the right investment, because you could put that exact amount of money somewhere else, like the stock market or Bitcoin, and get a better return. And that's what people will do. That's what investors should have been doing the last 30 years. But the tax code and the laziness of investors have not incentivized them to do that. So they just buy houses, leverage more houses. All the while, if you're the one then and there buying it, you're fine. But the person who buys the house 5 years later is that much worse off than you were, because they're too slow to that Cantillon effect of the money rolling out. They're too slow to access that beneficial ability because of how old they are and their wage. When you come out into the workforce and you're 20, you're at the bottom tier of the pay scale, whatever it is. You go to uni for 4 years, you're not getting a job till you're 23, 24. And then you're on the bottom pay scale. So that takes you to 30 to start earning a half decent wage. Then you need to save for 5 years. You can't buy a house till 35. As opposed to the tradesman who comes out and maybe drops out of high school and does a trade, and they're on a full-time wage at 22, and then they can buy that house at 25. So that's a good microcosm and a good snapshot of, if you look around at your tradie friends, how are they set up financially? That's the reason why, because they're the tradesman that works on a house, and everyone in their circle tells them to buy a house and invest in housing. And so they save up and they do it, and they get into the market 10 years before that university educated professional. It's not a gripe. It's not a problem that I have. It was my direction. It's exactly what happened to me, but I'm not angry about it. It's just a reality of the situation, right? It's a reality of the economy and of the society's expectations of where we are as a nation. But people holding 5 investment properties at 2% yields in suburbs they've never visited, they're not sophisticated investors for the most part. They're dependent upon policy, and the budget just kicked them in the shin. And it's the same reason why the banks in the last 30 years have been phenomenal on the stock market. Investing in a bank stock has been great, because when you take that loan, they create money out of thin air and earn interest on it. That's free money. They're getting paid free money, free yield. But the banks on the stock market have seen declines in the last 24 hours and will continue to see slight declines, I think, because the incentive for investors it hasn't been completely kneecapped. It's just been, we're yet to understand what effect this will have on the property investor. So when you have a demand for people who want to be in Australia, you can keep moving that level of tolerance. You can keep adding to that barrier to entry and making it more and more difficult for people to want to stay here, right? And what I mean by that is, people who have the wealth, have property, have investment, you can make it hard for them until you see them all exit. And then you go, okay, we've gone too far. Because at some point that threshold exists, and it's probably been too positively geared towards the investor in houses, all these tax benefits. So they're pretty happy and they've done really well. But when you get to that threshold, they throw their hands up and they'll leave, because Australia is a great country and lots of people want to live here, and there's lots of opportunity. It has beautiful nature, enjoyable lifestyle. And if you're in a country that you need people to come to your country, like Dubai, Singapore, then you create favorable tax laws, no capital gains tax. You make all these, we'll give you $10,000, we'll give you a house, we'll give you rent-free assistance. They have all these incentives in Europe where they give you things for free so that you will come to their country, because they need a population. If Australia is in the positive side in that we have a really high demand of people who want to live here and people who want to sort of invest here, but they want to invest in property here. They're just storing their currency. Like Chinese investors China won't let me invest over there, and the investment sucks. The property market sucks in China. So we'll take our money to Australia. We'll just buy a house. Doesn't matter what it costs. That's who you're bidding against in the popular suburbs is the buyer's advocate from the Chinese citizen living in China who will just pay anything for a house anywhere, and they don't care because they know it will go up over time. I mean, that's the luxury of living in Australia, is that you can test out where that threshold exists within the tax incentives, and they can push people around until they get disgruntled and leave, and then you'll have a problem on the counter and on the reverse, or you'll turn into a society where it's just it's mostly immigrants working, and the Australian business owner chooses to leave or chooses to shut down their business and coast and not work because the government has made it too hard for them to do so. If somebody asks me what are my thoughts on capital gains taxes and negative gearing, well, as I've been saying for the last 2 years, if you're buying a PPR, a primary place of residence, no worries. You can overpay for that asset, but because it's a lifestyle choice, it's a lifestyle asset. But it's not really an investable asset, because if you're going to put all your income into that house and to continue to do it up and make it worth more, that's fantastic. Unless you're a professional, like my younger brother who renovates houses and flips them, he has a strength that I don't have and that many people don't have, where he has the skills to do that labor. He doesn't have to pay the professional to come in and do these jobs because he can just sacrifice his time and make that money. So he's basically paying himself to do that job. He's earning money by renovating the house. So if you have the capital to do it, that's how you do it. That's only in your primary place of residence though. And if you're going to do that, then how do you access that wealth down the track in 10 years, 20 years, 30 years? You've got two options, right? You can sell it and move to a smaller house, which is mentally really hard to do. You're paying stamp duties and the taxes along the way and the real estate fees, or you borrow against that asset, that leverage that you have, but you have to keep working. So let's say you buy the house, you pay it off, you've got $1 million house, you might borrow $200,000. That's the only way you access the money in that house. You can either sell it or you borrow against it, pull the equity out, and then you do the things that you want to do, like buy the boat or go on holidays or just live. Or it's the only way you can access the wealth that is tied up in that house until you sell it. But when you sell it, you still have to buy somewhere. You still have to move into another property. So unless or you can go rent, but unless you're going to do that, or unless you're going to sell a house in one suburb and move to a completely different suburb where the houses are cheaper, you can't access the wealth you've earned. You have to keep working forever. The point is, it's fine, but you have to keep working forever. But my thoughts are that they should have had the guts to make these changes 10 to 20 years ago, because what they've done is the government has turned housing, which is a utility, people live in it, they need it, and they've turned it into an asset. So people think your primary place of residence is an asset, but it's really not, because you can't access the wealth. For the investor who owns 5, 10 properties, it is an asset and it's worked for them. And that's not their fault. That's clap your hands to them. They worked hard, they figured it out, they did it. And there might have been some luck in there. But to have that conviction probably took some guts. And their tax bill has been large and will continue to be large. But houses have been both an asset and a utility. And what the tax rules do and dictate, they define a direction that heads. It puts a ceiling on the growth. That means a young person buying a house, assuming it's going to double in 7 to 12 years. That's not going to happen anymore. The saying used to be in the 2000s, houses double every 7 years. Then in the 2010s, houses double every 12 years. The growth was slowing. House prices will still go up because of monetary expansionary system and a debt-based Ponzi system that we exist in. Money has to keep expanding to keep creating more debt to pay off the old debt. That's what the Ponzi is. And so that's when the person sits there and goes, yeah, but who do we owe the debt to? Well, we owe the debt to ourselves and to our pension funds and to our retirees and to other nations around the world. And we have to keep growing the debt to pay off the old debt because we're not making a productive good. We're not making productive money and investing in something and making a gain on it. Essentially, if money is in one place, by definition, it can't be in another place. So if money is in your house, then it can't be in your business. If money is in the stock market, you get one choice to put your dollar where you want to put it. If you put it in the stock market, then it's not going into houses. And what this is shifting is the money from houses moving somewhere else. But all these headline grabs of whether this is good for young people, this is bad for young people, oh no, it's going to cause rents to increase. It's not necessarily true. That the changes are not good nor bad. They're just changes. And you have to realize what they are to make your decisions. That's what it's about, learning about it so then you can decide. But your house can't go from $2 million to $4 million if people can't service it. That means earn the money to pay for it. If people don't have incomes high enough or enough equity in their last house, then they can't pay $4 million for that house because the money doesn't exist. And the bank's going to say, no, you only earn $100,000 a year. You can't borrow $2 million because it will cost you more than your income just to service the debt. That's serviceability. You can't do it. If you're someone who's just bought a house in the last couple of years, you're sort of stepping into the asset right at the top of that tree. And that sucks because property growth might stagnate for a while. What are these people going to do? Are they going to offload properties in the next 12 months, 24 months to beat these changes so they don't have to pay as much tax? Because when all this supply comes on, what's that going to do to house prices? Long term, it's fine, but it's just the timing of it has probably sucked for you. If you buy that house thinking, I'm just going to wait till it goes up in value, I'm just going to buy that $500,000 house and then I'll wait 5 years and it'll be worth $750,000. That's not going to happen anymore. Unless we get significant extravagant inflation because government malinvestment and poor spending, which might happen, it's unlikely that houses go up significantly in the future. But you're sort of stuck on that wheel. You're stuck having to pay that asset off now because housing's been demonetized by this decision slightly. And that's not a bad thing. That's not necessarily a bad thing. I'm not saying it's a good thing. I'm not saying it's not necessarily a bad thing. But the shitty currency, the Australian dollar, and holding that and that devaluing, that's what incentivizes putting that money somewhere else, putting it into the house. And now the government steps in and tries to fix what they changed, fix their own stuff-ups, which will create future problems that they can't foresee yet. And then what will happen? The government will step in and try to fix that. You have to look at the issue and change your mind when the facts change. If you're a rigid-minded person and you don't change your mind when the environment around you is changing, then it's just a naive way to look at it. You can't just put your head in the sand and assume that everything will be okay because it won't. These rules put a ceiling on growth now. The government even said 2 years ago they want slow property house growth. They don't want to kill it. They can't. It will destroy the entire economy if house prices go down 20%. It will destroy it because so many people will be underwater in their loan. They created this problem many years ago when they made housing the utility an investable asset. And now young people can't buy houses and they're feeling disillusioned because they feel like they're going to rent forever. Don't be the frog in the boiling pot where you just sit there swimming around in the water, not knowing that the water's heating up, and then instantaneously you pass out because the rules have been changing around you and you've just still been swimming in that asset class, everything's fine here. You need to learn how to invest in other assets, diversify your risk. Because if you only own a property, you are completely 100% exposed to property as your only asset. And if it doesn't grow, then you just continue to work 30 years to pay it off, and that's cool, but that's all then you still got to work. Then you've got to somehow retire or enjoy your life. There's much more wealth to be made in the stock market than in housing, and you need to look into Bitcoin as an evolving asset class and what that is going to be in the future moving forward.